The 60/40 portfolio. It's the gold standard of investing for decades. 60% stocks for growth, 40% bonds for safety. But here is the million-dollar question. Once you set it up, should you rebalance it every year to keep that 60/40 split? Or should you just let it drift and never touch it? Today, we're backtesting 98 years of data, from 1928 to 2025, to see which strategy actually puts more money in your pocket. First, let's define the contenders. On the left, we have yearly rebalancing. At the end of every year, if stocks have had a great run and now make up 70% of your portfolio, you sell some stocks and buy bonds to get back to exactly 60/40. It forces you to systematically sell high and buy low. On the right, we have no rebalance, or drift. You start at 60/40, but you never touch it. As stocks generally outperform bonds over time, your portfolio naturally shifts. By 2025, a no-rebalance portfolio actually looks more like an 80% equity portfolio. You're letting your winners run. Let's look at the results. If you invested a $10,000 lump sum in 1928 and held it until 2025, here is what you'd have today. The 60/40 rebalanced portfolio grew to $25.7 million. That's an 8.34% compound annual growth rate. Solid. But look at the no-rebalance strategy. Because the portfolio drifted heavily into stocks over the decades, it grew to $69.7 million. That's a 9.45% CAGR. And for context, 100% S&P 500 grew to a staggering $115 million. So, purely on final dollar value, doing nothing, no rebalancing, nearly tripled the returns of the disciplined rebalancer. But wait, investing isn't just about the final number, it's about the ride you took to get there. Look at the risk metrics. The rebalanced portfolio had a standard deviation of 12%, while the no-rebalance portfolio was much wilder at nearly 16%. The real killer is the volatility. The rebalanced portfolio's worst single-year drop was minus 27%. The no-rebalance portfolio? It dropped minus 36%, and 100% stocks dropped minus 44%. So, the trade-off is clear. Rebalancing sacrificed about 1% in annual returns, but it significantly smoothed out the crashes. This chart shows 20-year rolling returns. Look at the green line. That's the S&P 500. Even during the Great Depression or the 2008 crash, there was no 20-year window where you lost money. Even if you started investing in 1929, right before the crash, a 20-year hold was still positive. The blue line, rebalanced, and orange line, no rebalance, track closely, proving that over long horizons, time in the market is the most powerful force. So, why rebalance if it makes less money? Rebalancing acts as a volatility dampener. It cuts your worst single-year drop from that terrifying minus 36% down to minus 27%. It also results in fewer negative years. 21 negative years for the rebalanced portfolio versus 26 for pure stocks. It comes in handy if you are a retiree and need to withdraw funds for living expenses. However, there are disadvantages. You may experience bond drag, like in 2022, when both stocks and bonds fell together, breaking the traditional correlation. Here are the essential findings from this massive dataset. 1. Time horizon is everything. Every single 20-year window since 1928 produced positive returns. 2. Rebalancing reduces drawdowns. In 2008, the blended portfolio fell far less than pure equity. 3. Young investors should skew equity. The data shows that higher equity exposure pays off enormously over 98 years. 4. Rebalance annually, not constantly. Yearly rebalancing captures the benefit without excessive trading costs. 5. Bonds aren't always safe. As we saw in 2022, correlations can break down. 6. Invest a lump sum. $10,000 in 1928 became $25 million. Waiting to time the market consistently underperforms. To wrap up, here is what 98 years of history tells us. Number 1. Time in the market is the most powerful force. Number 2. A 60/40 rebalanced portfolio turns $10,000 into $25.7 million with lower volatility. Number 3. No rebalance drifts heavily toward equity, turning that same $10,000 into nearly $70 million, but you have to stomach massive crashes. Number 4. 100% S&P 500 wins on total return, but requires a tolerance for minus 65% maximum drawdown crashes. Number 5. Allocate by time horizon. Be equity heavy when you are young, and shift toward that safer 60/40 mix as you approach retirement. Finally, a quick disclaimer. This video is for educational purposes only. Past performance of the S&P 500 does not guarantee future results. This is not financial or tax advice. Always consult a qualified advisor before making investment decisions. Thank you for watching. You've just seen how we're turning data into wealth. If you want more insights like this, subscribe to the channel. Hit the like button, share and comment below to discuss what similar videos you'd like to see next.